Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hello, everyone. I'm Zach from Earmark, and thanks for joining us today or watching this on demand. And today's webinar is Navigate the One Big Beautiful Bill Act for Tax Season 2026. I'm going to hand this over to your two instructors for today, Roger and Annie, and they are both the hosts of Federal Tax Updates. Please, if you're not a listener, check it out. All right, Roger and Annie, take it away.
Thank you, Zach, and thanks everyone for joining us today. I am Roger Harris. I'm joined by Annie Schwab. As Zach said, you may know us through the Federal Tax Update podcast, and hopefully you've listened to them or will listen to them in the future. If not, Annie and I both work for a company called Padgett. Padgett's a 60-year-old company that at the client level provides accounting, tax, and payroll services to small businesses and individual taxpayers. We at corporate provide the support for all of our offices. We provide them with their technical needs through software. We provide, and Annie's the head of our tax department that provides them tax support. We provide practice management. So, and we'll have some emails and some links at the end of the webinar if you want to have a question or learn more about Padgett. But with that, let's go ahead and get started. And Annie, let me welcome you. How are you doing today?
Doing pretty good. We're only a few days out from Christmas. My kids are about to be out of school. I'm not going to lie. It's a little stressful, but I'm ready to wrap this year up. So,
yeah, I think we're all ready to get 25 over, but that just means 26 starts, and it's going to be an interesting tax season. We're all, if you've listened to some of our podcasts, you've heard some concerns about the readiness of the IRS and when will tax season start and how will they react to some of their cutbacks. But that's not for today. Today, we're going to focus on, we have a new piece of legislation. I'm sure all of you know this, the One Big Beautiful Bill, and it's got a few other names, but we'll stick to that one. And we're going to touch, I don't know that in an hour we can touch everything that's in the bill, but we're going to focus on where we think the most important things are the ones that your clients and your employees need to understand. So Annie, walk us a little bit through our agenda and what we're going to cover
absolutely.
today.
And thank you, Roger. I'm excited to be here today. I enjoy doing our podcast together, but this webinar is going to focus on OBBBA. And as I see that our slide deck has two typos there. Clearly, it's OBBBA, but we'll start with some individual provisions. There are the big four new deductions. We'll definitely cover those. We'll focus on some of the business provisions and then some other notable items. We are happy to take questions. So I believe in the comment box, I see a couple of people mentioning, saying hello and where they're from. I'll be monitoring that. So if you have a specific question as we go through the content, feel free to to type in there. And with that, I think we're going to go ahead and get started. So the passage of OBBBA, if you recall, this was actually passed into law on July 4th of 2025. It was over 900 pages. We would say it was a sweeping overhaul of federal tax law, but also had significant implications to fiscal policy. There was some effects to both federal, state, and local tax systems. So it covered a wide range of changes. The hard part of kind of navigating this bill is there are some things that or retroactive all the way back until January of 2025. Others will start in January of 26, and then there's some with effective dates all over the place. So we'll try to make sure that we are clear to describe kind of which ones are going to affect the 2025 tax year, which ones are coming in 2026, and maybe there's some planning opportunity there. But like I said, if you have a question, go ahead and type it in the chat and we will get started.
Yeah, and if you're watching this on demand, at the end, you will have an email address that you can send questions to, because if you're watching this on demand, we're not here to answer your questions. So you can type them wherever you want to, but we won't be able to answer them unless you type them and send them to the email address at the end. As I think most of us know, a big part of this was the fact that the Tax Cuts and Jobs Act, which had kind of been the law we've all been working in for a while, was set to expire, or parts of it was set to expire. And so a big part of the OBBA was to make, and I'm going to say permanent and then explain what I mean by that, make part of the Tax Cuts and Jobs Act permanent. Now, permanent doesn't really mean it can never be changed. It means, number one, it's not set to expire like a lot of parts of the tax code are. They do have expiration dates, and we'll talk about some of those as we go through other parts. So it means it's not set to expire, but it doesn't mean it can't be changed or replaced. So it's permanent unless, let's say right now, the Republicans control both the House, the Senate, White House. If that were to flip in the next presidential election, where the Democrats would control all three of those branches of government, they could certainly come in through legislation and change these. But they are permanent unless Congress makes a change. So what they did is, these are the tax rates that were in the original Tax Cuts and Jobs Act, and they have been made permanent. So again, keeping in mind what the definition of permanent means here. So as of right now, these are our tax rates going forward. They do not expire unless Congress changes them. These are our current rates. It also made permanent the increase in the standard deduction. Now, the standard deduction does have some annual changes to it, so it's not permanent in these numbers. But what we remember happened when the Tax Cut and Jobs Act happened is we saw significant increases in the standard deduction and some restrictions or cutbacks on itemized deductions. So I think we all experienced more people not itemizing because of the increase in the standard deduction. So again, the OBBA made this part of the Tax Cut and Jobs Act permanent. And I'm thinking for a lot of our people, though there's some things that might make itemizing more attractive, and we'll talk about those, the people who have not been itemizing recently probably will not, because this standard deduction is still going to stay up at its higher numbers, and those are, of course, the numbers. But Annie, talk about some of because there have been changes to itemized deduction. So while more people may not itemize, there are some ways that they'll be more encouraged to itemize, in some cases where they won't be itemizing. And let me throw one broad caution in, and we may do this 2 or 3 times during the webinar. We're focusing here on federal law. States are going to all have to make decisions how much, if any, of this they adopt. So make sure you check your state to see if anything we're talking about here is going to actually apply in your state. It may all apply, none of it may apply, some of it may apply. So be very careful, and hopefully the states have made the decisions on that as we are this close to the start of filing season. But Annie, walk us through some of the changes to itemized deductions.
That's correct, Roger. There are, with the increased standard deduction and then some changes in 2025 tax returns, and then additional changes in 2026, the nature of being able to itemize will probably change for most. For this year, we do have the suspension of the miscellaneous itemized deductions. Those are those 2% deductions. The only one that was preserved is the educator expense. That includes teachers and instructors as always, but it has been expanded to include like basketball coaches or sports administrators or principals and aides. So who qualifies for this educator expense has been expanded, as well as the qualifying expenses. So now you can have supplies for like instructional activities, not just for something in the classroom. They are still deductible as, they are deductible as itemized deductions, but just not as miscellaneous itemized deductions. So I know that's a small screenshot there, but you can see the change in the form for 2025 as it relates to the 2%. We also have the qualified residence interest. This was made permanent, as Roger has mentioned. Permanent may not actually be permanent, but for now it is considered permanent with the Tax Cuts and Jobs Act limitation on mortgage interest deductions. And it expands the definition to include mortgage insurance premiums. So you can see there on the chart, Tax Cuts and Jobs Act of 2025 is kind of where we're living. OBBA for 2026 has adopted those. So, the visual to me makes things a little bit clearer, but it does treat mortgage insurance premiums as qualified resident interest, and that's the key takeaway I would say from this slide here. SALT, there was a lot of stuff going on with SALT. We saw the state and local tax deduction. We saw, Republicans and Democrats all over the board. I saw one person, one congressman, saying 50,000 or 100,000, somebody taking it down to zero. This has been a area for, I guess, controversy, but where we landed is the SALT deduction is capped at 40,000. Originally, it was not originally, but last year it was at 10,000. That 40,000 would increase by 1% annually through 2029. So permanent, not really, because look here, it's saying in 2030 it will revert back to 10,000. But it did allow for households with modified adjusted gross income under 500,000 to qualify. Once you hit that threshold, there will be a reduction, like a scaling deduction back down to the 10,000. So I would keep, another good point here is this last bullet point. There was some talk in different versions of how the SALT deduction was going to happen. It did not impose any new limits on the SALT deduction for pass-through businesses. So allowing the state pass-through entities to continue to avoid the SALT gap. Something to consider as you're talking to your clients as we reach year end, that could be a beneficial treatment, depending on your state level. But the SALT deduction for most of us, 40,000, under 500,000 will qualify, and then you'll sort of get nicked a little bit as you get over. So this is formally called the PEAS limitation. And basically what that means is there's a limitation for high income taxpayers as it relates to itemized deductions. This goes into effect in 2026, so tax years effective after December 31st of 2025. And what it does is it reduces itemized deductions by 3% of AGI over a certain threshold, and it can be up to 80% of total deductions. There's a weird calculation here about itemized deductions are reduced by 2/37 of the lesser of. All of those kind of nuances are just something to keep in mind. If you have high income taxpayers, you might want to consider, bunching and putting some of those into 2025 while this high income limitation does not apply. I would say, think about your state, include SALT in those calculations, and then keep in mind the PEAS limitation as of 2026. Roger, if you have anything to add, feel free to jump in here.
Yeah, I'll wait till you. I want to say something after you finish the charity, but go ahead and cover that.
Sure.
Now.
Another change, again, 2026, not for 2025. So just a look ahead here, charitable deductions for non-itemizers, the taxpayers will be able to take a standard deduction, but also deduct up to $2,000 for joint returns or $1,000 for all other filers. So that is new in 2026. If you happen to itemize the deductions for charitable contributions, it makes it more generous for larger gifts. So this is a different kind of scenario where it's now looking at the dollar amount of gifts rather than the total amount. So individuals who itemize can only deduct charitable contributions that exceed 0.5% of AGI. This new floor means smaller contributions may no longer be deductible, and unused deductions can't be carried forward. So as you're talking to your clients, especially those who are traditional itemizers with large deductions, or perhaps non-itemizers who would like to start, you know, providing, giving charity and donations, these are two talking points I would say to keep in mind as you look forward to 2026.
Yeah, and a couple of things here. Again, this is another reason where the standard deduction could be more prevalent, because if you get the standard deduction plus some charitable giving here, it may, again, not make your itemizing profitable. Another trick, and again, this is probably true, and I'm not saying something you don't know, but states handle itemizing and standard deductions differently. Some say if you've itemized at the federal level, you must itemize at the state level. Some give you the ability to go back and forth. This might make it a little more complicated. There are times when it's better to force someone to itemize at the federal level, even though it's technically not as much as the standard deduction, because the standard deduction at the state level is so small that they would pay more in state tax. So again, this is just going to make that issue something we're going to have to look at a little closer, depending on how closely your state follows the new rules, and secondly, how your state works with itemizing, and consistency between federal and state. And the whole real issue, again, is how quickly can the states, depending on how their legislature meets and what their law says, do they automatically comply with federal law? Does the legislature have to come in and pass a bill to say that they do? There's all kind of conformity rules. So state taxes for this first year may be a challenge that we need to watch. But again, there's going to be possible ways to save your clients money by paying attention not just to the federal level and making decisions solely on how the federal return would come out, but also incorporating how it impacts the state and what it's going to do there to make sure that our clients are getting the best. Because they're going to look at it in total dollars. They're not going to care, how it floats from one to the other. So just another tip, again, something to make sure we have our radar turned on to making sure for this first year particularly, well, I guess next year, because some of these things kick in next year, but for the next couple of years, we're going to have to really pay attention to both the federal and the state and look at them as a total package, not independent of each other. Okay.
And I will kind of, that's fine. I will kind of piggyback on what you're saying. And there are going to be states who will have more complex changes to the 2025 software. So I imagine that we will see some states come out with their finalized forms before others. Some will have to implement, like Roger said, additional changes. Some will just accept federal. Some work off of the federal AGI. Some do not. So, there's probably going to need to provide some grace for certain states that are really trying to work through all the new legislation and make sure that their forms and their softwares are up to date. Okay, gambling rules. So again, this is another notable thing. For 2025, the OBBBA does not change the rules for deducting gambling losses. So 2025, you are good. Taxpayers may deduct gambling losses up to the amount of winnings, provided they itemize. The kicker kicks in at 2026 or later, where it limits the deduction to 90% of the gambling losses up to the amount of gambling winnings, which can, and I'll walk through these examples with you, create what they're terming phantom income for higher effective tax rates. So simple here. Example 1, winnings 10, losses 10. Well, in 2026, you can only take the 90% of the 10. So deductible losses of 9,000. Example 2, you win 100,000, but you lose 110. So now you're looking at 90% of the 110, but limited to winnings. So the 99,000 would be your number there. Example 3, 1.4 million, losses 1.2. 90% of the losses is 167 versus because it's limited to the winnings. So a lot of just nuances here. It's kind of a change in the mindset, thinking, oh, okay, well, it's not real. It's not like losses can offset winnings and you're doing all this netting of items. It's more of, the limitation of the 90% of the loss, but limited to the winnings. So I don't know, Roger, I know you head to Vegas a lot. This is probably not making you happy.
Well, losing never makes you happy, and not having to be deducted. But this is one area, this was put in, and again, not to get too much in the weeds and how tax bills are written and passed. They receive a score based on how much tax they increase or decrease. And so you have to find a way to, quote, pay for these things. This was a pay for that was put in. I have no idea how much money this actually generates, but obviously you try to think through this. Well, why would they do this? What's the purpose of this? What is it trying to do? Doesn't have anything to do with encouraging or discouraging gambling. It's somewhere in some back room, this change generated a lot of money to pay for something else that someone wanted in the bill. Having said that, this is also the one piece, or one of the main pieces of the legislation that there has actually been discussions of changing. I'm sure it's not going to surprise anyone that the Nevada senators are not in favor of this.
Right.
It kind of caught a lot of people off guard. I don't think, like most bills, nobody read it all until it got out there. So there is some talk of repealing this, but it has not happened yet. There's nothing that says that it, necessarily will happen or not happen. But the senators from Nevada want to go back to the old rules. So again, it won't affect us this year. It'll be something we'll have to deal with next year. So there's a chance this goes away. But if they make it go away, they got to find something else to bring in and replace whatever dollars this generated to get something in there. So again, 90% of your losses up to the extent of winning. So there could be a 10% gap there that people have to pay tax on, even though they lost more than they won. So it's not going to make anybody happy if it stays in the tax law next year. Whether you're, I can't imagine gambling on 1.4 million, winning 1.4 million, or losing 1.3 million. But professional gamblers, this might really impact. So, but we'll keep an eye on it to see if it changes. But it's the law right now, starting in 2026.
All right. Child tax credit, again, this was a hot topic as the negotiations are going back and forth. Where it landed was the bill did increase the amount of the child tax credit to $2,200 per child, so that'll start in 2025. Believe it or not, the child tax credit had never been set or indexed. So now this bill does make it index the credit for inflation. It also makes permanent the $1,400 refundable additional tax credit, again, adjusted for inflation. And lastly, makes permanent the income thresholds, which are $200,000 for individuals, $400,000 for joint, as well as the $500 non-refundable credit for each taxpayer. So kind of reverts back to some of Tax Cuts and Jobs Act, but also increases the maximum amount. So for those of you with clients who usually qualify for the child tax credit, a few tweaks here, but nothing crazy. A couple of other family-related provisions, child and dependent care credit. Those can be deducted. Child dependent care credit has been increased starting in 2026, so that's not this year, from 35% to 50%. Pretty big jump there. And then there's a phase out down to 20% if AGI reaches a certain limit. So maximum percentage rate has gone up. The employer dependent care assistance, that also has gone up. The maximum has gone from $5,000 to $7,500. Again, a decent jump. The paid leave has gone from employers can claim the non-refundable credit from 12.5 to 25% of wages. That was also a significant increase. And then lastly, the adoption credit is refundable starting in 2026. That's set up to $5,000. So a few minor changes, summer 2025, summer 2026. Again, for those of you with clients, who qualify for some of these things or have employers who pay paid leave, notable to have discussions with them. Again, not crazy changes. All right, well, let's get to the fun stuff, Roger, because that's just kind of like things reverting back and making tweaks, but these are new, and I've heard them called the Big Four, but I think we have a couple of extra slides beyond the Big Four of the new deductions.
Yeah, these are the ones that you heard a lot about during the presidential campaign. You've heard a lot about it when this bill was being debated. Kind of not exactly what was talked about in the election, which is not surprising in terms of how they finally got instituted. But these are going to be major changes for people that are impacted by these. And the first one is what we all heard during the campaign as no tax on tips. Now, if you are a waiter or a waitress in a restaurant, you heard that, and I'm sure you heard no tax of any kind on my tips. Well, that's not exactly true. What we have is no federal income tax on a certain amount of tips. They are subject to, the payroll taxes. Again, we don't know whether states will adopt this deduction or this or not. So they may pay state tax on it. But for federal tax purposes, there is no tax on tips up to $25,000 per taxpayer. And there are, as is true in almost every part of the tax code, there are income thresholds for which the deduction goes away. Now, so that's broadly what the rules are. This is retroactive, by the way. Remember, Annie mentioned that the bill was signed July the 4th. This deduction, and we'll talk about overtime and some others, is retroactive until January 1st of the year. Well, no one made any record-keeping changes January 1st about a piece of tax law that didn't exist yet. So there can be some challenges. There'll be challenges here. There'll be challenges in overtime and all these things because of the retroactive nature of this deduction. But here are some guidelines so we're going to have some rules for 25 that are not going to necessarily be true for 26, because one of the things we have to be aware of is there's really no real changes in the payroll tax reporting for 2025. That will take place in 2026. So the first question that we have to think to ourselves is, so I have someone who works in an industry, and that's the first thing to be. There are industries that Treasury put out where tips are qualifying for this deduction. And some of them don't make any sense. There's some businesses in there that I didn't know. I guess I've been a bad customer because I never tipped my plumber, or I never tipped some of the people that were on the list. So I guess I was just a bad customer. So there are some. So the first thing is the tips have to be in an industry or a business that's in this list that Treasury put out. Surprisingly, there is debate not about taking people out, but having too many businesses in that list. They held a public hearing, and people came and wanted businesses removed from the list, meaning that the tips in that business would not be subject to this break. So we assume that the list we have is our final list, but it's subject to change. The IRS and Treasury could make a modification. So the first thing is, did the tips get paid in one of these qualifying businesses? For those of us that deal with people in restaurants and bars and things like that, Uber drivers, bellhops, things, common sense things. I mean, yes, those industries are covered, but there can be some strange ones out there that we're going to have to refer to the list. So they have to start by being paid to a person who works in one of these businesses.
And there's 68 of them, actually. Yeah. So the list is pretty long.
Yeah. And again, it could change. It could go up or it could go down, because we're not really sure where the list came from. Because if you just got nothing better to go look at the list, because you'll be surprised at well, how does that qualify and why doesn't other things? But again, common one: hairdressers, barbers, restaurants, bars, those sorts of things. Spas. Yeah, pretty obvious. So then the next thing is they have to be qualifying tips. So what is a qualifying tip? And one of the things that is going to be the most common for those of us who deal with restaurant clients is if you go into certain restaurants with a party size, say 6 or more, and they add a service charge, that service charge probably, I'm not going to say always because every situation could have its nuances, but probably won't qualify because it's not a voluntary tip without restrictions. And I'm paraphrasing the exact wording. So if you have a restaurant that charges, say, an 18% service charge to party of 6 or more, those are not considered tips. They're probably not considered tips in a lot of different ways, but they're certainly not considered tips for purposes of this deduction. So your clients have to know how to treat those at their level for payroll tax purposes and payroll purposes. But when we get to the income tax return, those kinds of service charges would not qualify. So what does a taxpayer need to bring to us or show us to know how to calculate whether they have qualifying tips? Again, the W-2s and all the reporting for 2025 is not going to change, but it will for 25. I mean, for 26, well, there'll be some additional blocks on the W-2. These business codes will be listed, so you'll be identified. But for 25, everything's going to look just like it has always looked to us. So the one nice thing that the IRS has given us in their early guidance on this no tax on tips is we can look on the current W-2 for that box where tips are separately stated as part of the, I don't remember the box number, but
I think it's box 7.
Box 7, which says tips. That number is a number we can use and say those are qualified tips if they're in that box. You know, unless, like in anything, unless we have some firsthand knowledge that that's wrong or something. So for the most part, if we're dealing with the typical waiter, waitress, taxi driver, hairdresser, we're just going to take the number in their off their W-2 in the tip box, and that is the deduction. And again, remember it's $25,000 per person, but one little trick here: one person in the family could have $50,000 in tips, and the other person could have 0, and the 50 is the number. It's the 25 per person is the maximum. It doesn't mean that only one person can each have 25. So
Correct.
Again, subject to income limitations. So the tips, even though it's retroactive, I think for most of us, we're going to be able to pull it straight off the W-2. Now, for self-employed people who also get tips, you're going to have to pay the self-employment tax just like the employee had to pay Social Security on theirs. But the deduction will still be there based on however you get that number. If it's on a 1099, or where it's going to get tricky is if you have someone who says I got tipped, but it's not on a 1099. It's obviously not on a W-2. I guess they're supposed to file the form and pay the Social Security tax on the tips when they file the return. So that form number would count. But for most of us, fortunately, we're going to be able to rely on the W-2, but there are going to be other instances where we can look forward to the 1099, whatever the case may be, and then worry about the $25,000 threshold. So, but again, it's not completely tax-free. We don't know how the states are going to treat it. So we're going to have to look to see if the number on the federal return has to be adjusted when we get over to the state return. Did I get it all covered, Annie?
I think you've got it. The only thing I would say is that the Treasury did come out, and they're calling this sort of like a transition year. So there's no penalties for employers who incorrectly report or fail to report tips on the W-2 or even 1099. So the employers kind of get a get out of jail free card. And in all honesty, like Roger said, I think it's going to be less important on the tip side because there's already some kind of reporting established. But on the overtime side, where this is new, there's not already a box on the W-2, again, retroactive to January 1. The get out of jail free card is actually going to, apply both to the employers not being able to report overtime and employees who don't have any documentation. How do they estimate? So I think you covered it, and we'll move on to overtime. I do see a couple of questions in the chat about, is there a worksheet that we can give to a client to report tips if you don't have a W-2 or items like that? And basically the IRS is saying any reasonable method of calculating the tips. So there is no worksheet provided by the IRS. Certainly, you could develop a worksheet if you have clients in certain industries that are very similar. Maybe a standard template or worksheet would be helpful, but I don't see any true clear guidance on this for 2025 at least.
Yeah, and you touched on this. The IRS has been fairly lenient in saying that I'm going to use the restaurant in this case. The restaurant owner who pretty much gets a get out of jail free card. The taxpayer pretty much gets a get out of jail free card. They haven't told us if we have one. We're assuming that we don't, but I mean, at what point do we need to ask questions and dig deep to make sure that, we're treating it properly? They haven't come out and given us a get out of jail free card, but I'm going to assume if they're going to be lenient on the business owner and the employee, that they'll be lenient with us as long as we've tried to follow the law as best we could with the information that we had. Overtime is going to be a little more tricky. And there's a couple of key points I want you to make sure you understand, and then we'll talk about some nuances. First of all, again, just like with tips, no tax on overtime is not true either. They're still subject to the payroll taxes, the Social Security and Medicare tax. So there are some taxes still on overtime. The other thing is, I'm thinking if I'm a worker who makes $10 an hour and I get $15 an hour on my 41st hour, what I heard and I read is that $15 is tax-free. Well, that's wrong. What is tax-free is that $5 additional. So it's not the full hour of earnings for that 41st hour. It's the excess, or that $5 additional. So I think we're going to have some clients who come in thinking one thing, and we're going to have to be, as we do in a lot of parts of the tax law, be the one to break the bad news to them. The tricky part is this is overtime as defined by the Fair Labor Standards Act. That's what most businesses that we deal with probably follow. But there are certain businesses, and particularly when you get into unions, they negotiate different rules for what they consider overtime. Like, we'll work 4 10-hour days and we'll call that won't be overtime. So, we have to, first of all, compute this extra $5 based on the Fair Labor Standards Act. So we have to make sure that any number that we're given for overtime was given to us based on the Fair Labor Standards Act, not some other harebrained idea that somebody had.
Which is time and a half. That's that traditional time and a
Right,
half.
traditional time and a half. There is zero reporting required for overtime. Now, maybe some of our people pay stubs separate regular time from overtime that will give us some information. The IRS guidance said, well, you need to go back to your employer. Well, that's assuming that the employer, remember, the employer didn't even know this existed for half the year. So could they even go back in their records and tell the employer or the employee how much overtime pay they actually received? So we're supposed to get something. They can just go get a statement from the employer. Again, the W-2 is not going to show us or tell us anything. This is where it's going to get a little tricky in terms of someone who insists they worked overtime. They went back to their employer and said, can you give me a statement saying what my overtime pay was? And the employer refuses. So now what do we do? Again, I think we ask as many questions as we can. We document what we can. You're going to see here, and Annie, remind me to go back because there are limits to this too. Okay. You see some examples here where when you can divide by 3 and divide by 4 based on, what information you can get from the employer that clearly would provide us cover, because this is the IRS telling us to do that. But in a case where somebody says, yeah, as far as I know, it's Fair Labor Standards Act. I don't know even what that is, but yeah, I think that's what it is. And I went to the employer and they couldn't tell me anything, but I think it was $10,000. Well, $10,000 of what? Full overtime, $5 overtime. This is the one that's going to create some difficulties for us this year, because again, particularly in the smaller of small businesses who aren't the greatest of all record keepers, it's going to be very difficult for their employees to come to us and say, I have a statement from my employer. And the other one that's going to, I'm afraid, pop up is somebody says, well, I get a salary, but I work 60 hours. So there has to be overtime. Well, not necessarily.
Not
So
necessarily.
this one is going to present some challenges to us, but again, in a couple of ways. First of all, people are going to think, in my example, that the full $15 is tax-free, not just the $5. They're going to have zero records. They don't even know what the Fair Labor Standards Act is. They may or may not be able to get anything from their employer, but they're going to want the deduction. And again, the IRS has kind of said, do the best you can to the employers, do the best you can to the taxpayers. They haven't said that to us. So to the extent that we can track it, do due diligence, ask the right questions, and maybe be conservative, because when we go back to what I told Andy, remind me, there are limits here, like there was on tax on tips. So it's $12,500 for an individual or $25,000 for a joint return. So, and we do have income phase outs, but it's still substantial. It's going to be something that if people worked overtime and their income is within the limits, they're going to want this deduction, but we're going to have little or no records for this. We're still waiting to know exactly what we've got to do for 2026. We expect some enhanced reporting for 2026. But for
A new
2025,
W-4.
yeah, they're changing the withholding. That's I find this humorous. The W-4 and the withholding tables are changed. Of course, most people couldn't fill out the old W-4, so I don't know why they think they can fill this one out. So, but they'll at least, because again, people are going to, if they what the plan here is, there'll be huge refunds handed out in April, May, June, March, and in an election year. So everybody will go, wow, this is great. But most people would like that money in their paychecks, not waiting till they file their tax return to get it. So now they're going to be sent back to the confusing W-4 and new withholding tables to try to make sure that they
adjust their withholdings to reflect there. Yeah.
I will also, go ahead.
Yeah, one thing, while this is a new deduction, it is not necessarily a permanent deduction. Right now, both no tax on tips and no tax on overtime is for taxable years 2025 through 2028. So, it'll be interesting to see if it could be, extended, of course, but, just keep in mind that it's not necessarily forever, at least how it stands on the law.
Right. The end date is, again, the realities of tax law and government spending versus campaigning. No one said, well, I'll give you no tax on tips for a while. I'll give you no tax on overtime for a while, but there are deadlines here. The other one we heard a lot in the campaign was, we shouldn't tax Social Security.
Right.
If you go back a while, there was a time we didn't tax Social Security. Now we tax up to 85% of Social Security. Well, when it came time to actually write the bill and they did the calculation of how much the government would lose by not taxing Social Security, it was pretty clear they couldn't afford to do that. There wasn't enough other ways to pay for it. So what we have now is a senior citizen deduction of up to $6,000. Again, with income limitations and things such as that. And this would be on top of the standard deduction. So there's phase outs on it. So we don't have no tax on Social Security. We have a new deduction, again, starting in 2025, going through 2028. This is the simple one because it's just a number and really calculations. I fully expect the software to probably do all of this for us. This is just something that we do. But there is still going to be tax on Social Security, but we'll get this on top of the standard deduction.
And if you're married, you have to file a joint return to qualify. Right. That is one little kicker there.
Okay, we got one more. This also got a lot of talk during the campaign. Car loan interest. And again, this is some of this stuff, if you've done taxes as long as I have, you remember when we could deduct any kind of interest, credit card interest, car loan interest, whatever it was, interest, it was deductible. Then they took it away in exchange for lower tax rates. Now, again, partly driven by politics, partly driven by the incentive to buy American-made cars, we now have a new deduction of up to $10,000 paid or accrued on a post-2024 loan to purchase a qualified passenger vehicle for personal use. So it's new cars. And here's something we all know off the top of our head when somebody buys a car, where it was finally assembled. But there have to be final assembly had to be in the U.S. Now, how in the world are we going to know where a client's car was assembled and what constitutes final assembly? Well, fortunately, we don't have to figure that one out. We can look at certain things. The dealers will, now, according to the salesman, I'm sure they're going to tell you every car qualifies. So don't believe what the salesman tells you. But there are certain things. There can be information labels on the vehicle identification or VIN number. There's an indicator there that if it starts with, do you remember what it starts with? Annie?
No, there's a certain number that means where it was located, and I've just learned about the decoder. So there's apparently a website you can go to and put in the VIN number, and it'll tell you the history of it. Went here, went there, final assembly here, that kind of thing. So I'm with you. I think the salesman might not get it this spot on, but I do think that there's a way for verification. Unfortunately, your client's going to have already bought the car when they come in and think that they're getting the credit. So I hope that this is not an area where, you're trying to tell the client that they can't get something that they expect to have, and that's what the salesman told them and all of that. I would, take a look at the vehicle information label and the decoder for the VIN number, and I would rely on that.
Yeah. And again, like everything else, there's an income limit. And, we'll have to pay attention to that. But again, it's going to hopefully incentivize people to buy American cars. So those are some of the new stuff. Annie, this has had a lot of attention recently. Talk a little bit about the new Trump accounts that are being set up, which is also new, obviously, in this piece of legislation.
That's correct. So it is new. It's not considered a deduction, so to say, but it is new. And it's basically another form of a tax advantage saving account. This one is primarily for children under 18, kind of like an IRA, I would say. The purpose is to create savings accounts to promote early saving and financial inclusion. The maximum amount is $5,000. And then and that could be from a parent or whatever, and then the employer contribution is $2,500. So some key points here. It's created by you. Treasury is going to create some accounts for certain children, and I'll go over that in a minute, or a parent or third party can set up one of these. When you set it up, you have to designate it as a Trump account, and the child has to be under age 18 and have a social security number, and it's only one account per child. So like a parent, a guardian, and the Treasury can't all set up multiple accounts. But this is how it works. So the Treasury seed, so basically, if you are a qualifying child, so if you were born between 2025 and 2028, the Treasury will set up an account and deposit $1,000 in. I don't know if this is meant to be some sort of like pilot program or testing, but as it stands, it's only these select children born between 25 and 28 will get the Treasury seed. And that will be, the election is made by the taxpayer for the eligible child, U.S. citizen, social security number, all of those kinds of things. There's very little bookkeeping. I haven't found very specific steps. It does have to be made proactive by the taxpayer who's the dependent or the parent or whatever. It just doesn't automatically appear. I expect that we will see more on this, Roger. Every IRS meeting you attend, every webinar that I attend, this is something that we're still getting questions on. The idea is great. Why certain children? I don't know. Will this be treated more as like a pilot program and then tweaked? Maybe, but this is what we've got so far.
Yeah, and there's some states are now asking, certain states, not all states, are asking permission from Treasury for them to also contribute to these accounts. So it's possible that you'll get a seed money from the federal government and the state. Some billionaire helped fund this. I saw where he contributed money to I guess he gave it to the federal government to do these accounts. Again, there's no deduction here. These are like Ross. I mean, you just
Yeah.
put the money in, it bills, like anything, we'll get rules as to when you can take it out, what you can spend it on, all those sorts of things.
Is it transferable? All that kind
Yeah,
of stuff.
all this, but again, relatively new, but for qualifying children, they'll have at least $1,000 put in by the federal government, and maybe, parents and grandparents and all those can do it, but maybe something from the state, but we don't know. To make sure we have time for questions, I want to run through the business fairly quickly because a lot of this is not major changes. It's some tweaking and some thing. The business introduction doesn't always apply to our businesses, but they've changed the calculation of EBITDA in this case to be more friendly, to allow for more of the interest to be deducted. So if this has been an issue with some of your clients, they should get more than they have historically. The 199A was a big part of the Tax Cuts and Jobs Act. Again, to the extent we mean permanent, it was made permanent. The income levels got a little higher for phase outs. There's also a minimum amount of $400 for taxpayers with at least $1,000 of QBI. The basic rules are the same, but again, it's now permanent. It doesn't expire like it was intended to. And the income levels are a little higher for the phase out. The bonus depreciation deductions were made permanent. So again, this will help a lot of our small business clients in terms of the depreciation of the stuff that they buy. A big one that got a lot of attention in Washington, the R&D has gone back to expensing. There's also some provisions if you had people who amortized in the last couple of years. There are some rules. We don't have time to get in great detail where they can go back without
kind of like
filing.
a clawback.
Basically get the write-off that you would have gotten had it been expensed,
Mm-hmm.
Without filing a 3115. There's some ways simplified ways to do this. If you had anybody that had research and development expenses and were forced to amortize them, those are now back to write-offs. Again, there's restrictions and size and all those sorts of things. But for most of our clients, gross payments of, this is the 1099.
This one.
Jump the slide. There's some limits in terms of size of business and all that sort of thing, of course. For next year, not this year, the 1099 thresholds go up. The 1099K, which was a big headache for a lot of us over the last few years and what to do, has gone back to its higher threshold. So we're not going to have grandma that sold a refrigerator at a yard sale getting a 1099. But that's for 26, not for 25. And the 1099 NECs and miscellaneous amounts for those have gone up from 600 to 2,000. And that's going to make a big difference for a lot of our clients in terms of the 1099 miscellaneous that they have to issue.
And those are 2026.
2026. Both of these are 2026.
Yep.
This year, same rules apply. Any talk about energy?
Right. So there's a chart up here, and the takeaway is that there are several energy credits that are expiring at the end of this year. There are some with really weird dates, like that expires September 30th or June 30th, or will expire, June 30th of 26. So I have a list of them up here. There's no rhyme or reason, but eventually the goal was to expire most of these. So as you're working with your clients during tax season, just double check the dates, make sure that they do qualify. If a client is talking to you about some of these, potentially inform them that they could sunset very soon. But this is a good chart to just kind of keep handy. The employee retention credit, I don't know if it will ever die, because I feel like literally every podcast that Roger and I have done, we feel like we have mentioned ERC. It was something that, if you're not familiar with it, it's something that came out of the pandemic, a way to get money to employers who were paying their employees. The main point I want to reiterate here is that it prevents the IRS from paying out ERC claims filed after January of 24 for the third quarters of 21. So little nuance there. There was a repeal of potentially another version of this proposed. What I, key takeaway: no more ERC claim payments being sent out for the third or fourth quarters of 21 if they were filed after January of 24. If you're looking for more information on ERC, Roger and I have done numerous webinars that focus on this topic, so you can easily locate those for additional information.
A couple of other things. These aren't really part of the the big beautiful bill, but there's things that you will make sure you're aware of. If you haven't heard from it, the IRS is not going to send out paper refund checks anymore. Right now, they'll still accept paper checks, for payment, but I expect that to change quickly. So for those of you that still have people not wanting to write checks or receive checks, tell them to get over it and start getting their bank accounts and start dealing with the reality that paper checks are going away. Another one, the Where's My Refund has been improved. Now you can actually track the progress of the return from when it's accepted to when it's processed and the check. So a little more information doesn't mean it's going to speed up getting the refund, but at least you'll know where it is in the process. So that's going to be new this year. Individual online accounts. If you don't have one of those for your clients, there's online accounts for taxpayers, there's online accounts for tax pros, there's online accounts for businesses. This is where the IRS is moving a lot of the information and a lot of the activities to make our lives easier. We just need to accept the fact that our clients need online accounts, we need online accounts, our businesses need online accounts. The functionality in there will be a lot greater, but here's an example of what can be done in an online account. It solves a lot of the problem of writing checks because you can make payments through there electronically, so it feeds off of the other one. So encourage your clients, if they do not have online accounts, to go set one up. Do the same for yourself as the tax pro and have your businesses do the same, because this is where everything's going and you can only fight it for so long. And they're actually good once you get them set up. So, all right, Annie, we saved a little time.
I barely saved a little time. I thank you all for your attention. We had a lot of material to cover, but we made it through. I will say that we've been checking as we go, and I don't see too many questions in the chat, but if you have something, perhaps we missed it or has come to mind, please feel free to place it there in the chat. I do see that there's a link to the slides. So if a couple of people are asking for access to the slide deck, there's a link in there.
And in the chat, you should see a link. If you're watching this on demand, obviously we're not here to answer your questions. There is a link there to submit a question to, and we'll try to get back to you as soon as possible. I think the slides are there, you mentioned, and there's a link if you have any interest in learning more about Padgett. There's a link there on how to do that as well. So no questions that we haven't covered?
I don't see questions coming in, and I know we're almost at the top of the hour, but I do appreciate all the attendance. The types of questions that were asked about no tax on tips, no tax on overtime. I mean, those are the same kinds of questions that we're getting over at Padgett. We're doing our best to advise clients, answer the question. So if you have a question that we didn't change, please send it to us. I see the Padgett admin has entered some information there. Yes, it's going to be recorded. Let's see. Roger, can you provide an example of the overtime wage again, where only the $5 is considered the non-taxable amount?
Sure. If someone's hourly rate is $10 an hour, that means time and a half for that 41st hour would be $15 an hour. The employee, I think, is going to come expecting that $15 to be tax-free. I'm going to use that term, but you know the rules there. The reality is only the $5, the additional $5 that they got paid is
the incremental amount,
the incremental difference. So it's not the full 15. The 10 that they would have earned had it been the 35th hour is still fully taxable, but the $5 additional they got for working that extra hour would be tax-free, I guess.
We do have one more question with just a minute left here. If the W-2 reports the entirety of compensation, if we are submitted something at less than that amount due to overtime, how will they not reject it? Or maybe will they reject it, or what are your thoughts on just pulling a number that's less than the total? I mean, it has to be reasonable.
Well, the overtime would have to be less than the total because the
Of
total
course.
earnings, the W-2 is going to have the total earnings for the year. What we're looking for from the employer, if possible, is some sort of notation as to how much of those total wages are either overtime, full pay, the 15 to use my example that we could divide by 3, or if they can tell us the $5. But we're looking something from the employer to be a subset of that total amount on the W-2 that was paid to that person for qualifying overtime, subject to the Fair Labor Standards Act.
Mhm.
So I don't know how many small businesses have that information, but yeah, the W-2 is not going to tell us anything but how much their total earnings were. The overtime is going to have to come in some other form from the employer. Hope that answered it. If not, send us a question. Hopefully that clears it up.
Yeah. Okay, well, I think that wraps us up today. I will turn it over to Earmark for final comments.
Yeah, perfect. Thank you both, Roger and Annie, and thank for everyone who was here live. And if you are here live, here's a quick reminder on how you can earn CPE for attending today's webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.